So I want to go over with you in today's video the last time that our stock market had corrected based off of higher inflation and higher interest rates. Now in my previous vid, I talked about how higher inflation and higher interest rates again in the future caused by federal expansive monetary policies could issue a stock correction in 2021. The last time that this occurred was in 1974. It really started in 1972 when stocks peaked right here as measured by the Wilshire 5000 index. And I want you to take note as to where the inflation rate was at that time, as well as short and long-term interest rates. Now, I've measured the short and long-term interest rates by showing you the effective federal funds rate in light blue, and then in red is the 30-year fixed rate mortgage. So you've got your mortgage rates 30 years, which is your long-term interest rates. You've got your federal funds rate, which is the short-term rate, and that's the interest rate that the Fed targets every quarter to control interest rates on the short run. And then in purple, we have the consumer price index. So back in late 1972, the CPI was about 3.5% annual inflation, 3.4. Your mortgage rates were 7.5%, and your effective federal funds rate was almost 5.5%. And then notice what happens over the next year and a half. While mortgage rates stayed largely steady, they do get forced up a little bit. Look how high your consumer price inflation starts jumping. It jumps all the way up to 6%, and your effective federal funds rate is lifted by the Fed all the way up to 8.5%, and that starts putting this downward pressure on the stock market. Then stocks start languishing for a little bit, but eventually inflation starts picking up even more so. Now, why does stocks sort of flatline right here? Well, they flatlined right here because the Fed basically stopped raising interest rates on the short run, and mortgage rates sort of, plateaued right here. So stocks sort of had like a slight recovery, but then watch what happens. Inflation still keeps building, and it builds back up to 8%, and then the CPI just started to increase again and again and again, and that's really what caused this downward spiral in stocks. And then the Fed just basically admitted defeat and started raising the federal funds rate to sort of contain that price inflation. And it took a while for the price inflation to peak. It would peak in November of 1974, almost 2 years later, at 12%, and look how low the stock market dropped. So the stock was at a peak of about 1,090, the Wilshire 5000, and then it drops all the way down to 550 in September of 1974. So it effectively dropped by 50%, brought by these inflation rates and these higher interest rates. Now, that being said, today's environment is a little bit similar to the 1970s in the sense that we are going to be seeing rising inflation and rising interest rates, but there's a few differences, okay? Now, some of these differences work for us today, meaning that we may not see a stock correction quite as badly as we have in the 1970s. Some of these work against us. And how much these counterary forces will cancel each other out or work to keep stocks elevated or correct stocks downward, I honestly do not know. But I'll bring this to your attention, and then I'll let you make your own judgments and conclusions based off the data. So one of these is, let's take a look at the 30-year fixed rate mortgage. So obviously the 30-year fixed rate mortgage is way higher than what it is now. Current rates are about 3%. Right? Your 30-year is about 7.5%. Now, that works for us because we have much lower mortgage interest rates. However, something that works against us is that we have a higher percentage of mortgage debt as a percentage of GDP, which can be an effective measure of income, than we did back in the 1970s. So back in the 1970s, mortgage debt as a percentage of GDP was about 45% of GDP. it's now 75%. And this only goes all the way up to quarter 3 2019 because the series was discontinued and rolled up into another measure that the Fed issued out. So I'm sure that the mortgage debt is probably about the same, roughly speaking, since this is just, not even 2 years old. But let's just say that it's 75%, which means that today's 3% mortgage interest rates is equivalent to 1972, 1973's 5% 30-year mortgage interest rate. So that 5% 30-year mortgage interest rate is well below their 7.5%. So that's something that works for us, that, even though we have a higher amount of mortgage debt as a percentage of our economy and our economic growth, we do not have as much as high of interest rates. Now, that being said, what's working against us is that the Federal Reserve is actively buying mortgage-backed securities every single month. They're buying $40 billion of this. So what happens if the Fed is forced to stop buying these mortgage-backed securities? The interest rates on the mortgages will inevitably be pushed upward. Now, how high could they be pushed upward? I don't know. And obviously, there are many people who will just are holding mortgage debt, and so their interest rates won't get forced up. However, what will happen is that higher interest rates on mortgage debt will curtail lending of new mortgages going out, and it will also be degrading or give a disincentive for businesses and builders to make new housing, because the cost will be going up on the interest rates that they have to borrow. And then there's less of a return potentially for banks to lend out those mortgages, because the costs are going up, and then with tight credit that's been going on, banks are being extra careful about who they lend out to, and housing prices are escalating. So that could definitely be a problem. So, we do have some things working for us, but we also have some things working against us. Another thing that's working for us is that our federal funds rate is at 0.25%. The federal funds rate here is 5.33%, so it's a lot higher here than it was in 2021. And the Fed has signaled that they are not planning on raising that effective federal funds rate anytime soon. So short-term interest rates could be staying well below. So that works against us. What works for us? What works against us is that the inflation rate started at about 3.4%, and that's when our stock market peaked. But our inflation rate now is at 4.9%. So we're higher right now year over year inflation than what happened when the stocks peaked in late 1972. Now, with all that being said, I think what's going on here is that investors are giving the benefit of the doubt that because these higher inflation rates were driven more by an external event like a pandemic shutdown, they're sort of ignoring this 1-year inflation rate for now. And what I think that they're doing is they're not concentrating on the 1-year inflation rate. They're kind of concentrating on a 2-year inflation rate. So if we take what the CPI has done over the last 2 years at an annualized rate, the annual inflation rate is really only 2.5%, which looks a whole lot better than the 1 year's 4.9%. So I think investors are taking a little bit of a longer term look at this. Maybe not like they're not calculating this out, or maybe they are, but maybe instinctively they're guessing. They're saying, okay, well, this 4.9% is bad, but this 4.9% is really from an event that's out of our control, and we're reopening the economy. So we know in real terms the inflation rate's not all that bad, because last year inflation was pretty much flat. So they're doing this 2.5%. So then the question becomes, when are we going to reach that 1972 3.4%? Well, from what I can tell, I've kind of sort of projected the CPI inflation rate going into the end of 2021. Now, assuming my projection is correct, which there's no guarantee that it is, but assuming that it is correct, that would mean that the CPI would reach that 3.5% threshold when August's CPI numbers come out. But remember, that's not going to come out until September. So early September, when the 3.5% headline number comes out, that could be looked at as a potential signal that the stock market has peaked, of course. Now, all that being said, there's no guarantee of this. It could very well be that when July's and June's numbers come out, we could already start seeing the peak. But it really depends on when the Fed is going to relinquish their control over longer-term interest rates by stop buying the mortgage-backed securities, and then stopped buying $80 billion of 10-year treasuries. Because your 10-year treasury rate, although I don't have it on this chart, ran right alongside these mortgage interest rates. So there's no doubt that mortgage interest rates in our 10-year will be pushed up, but that does not mean that they'll be pushed up at the level that we were seeing here in the 1970s. Okay. Now, that being said, there is one of the things that's working against us is that our stock market is grossly overvalued compared to where it was in the 1970s. So back in the 1970s, the stock market was pretty much functioning, running right alongside at a 1.10 variable with the Buffett indicator, right? But that's not the case now. That's not the case now. We are grossly overvalued. So it could be that we are much more sensitive now, as I've shown in my last video, to a rise in inflation and interest rates compared to where we were in the 1970s. So we could spark a downward turn just by any kind of uptick in this inflation and interest rates, simply because our stocks are so grossly overvalued. There's been so much money piled into it and so few earnings turning out that it could cause a panic and could cause a reversal of fortunes inside the stock market. So just keep tuned to that. Anyway, I wanted to give sort of a sequel to my video that I posted yesterday and kind of just give you an update on that and point out, when was the last time we had a downward turn in the stock market, sort of just compare that to today. So anyway, if you like this video, click like and subscribe to my channel, and I'll keep posting more content as it comes out. Certainly the next big thing that's going to come out is the inflation numbers on Tuesday morning, and then of course the producer price inflation numbers that are going to come out on Wednesday morning. So I'll definitely be posting a video Tuesday night and Wednesday night. I don't know if I'll post one tomorrow or not. I think I'm just going to wait until that data comes out, unless if something extravagant comes out tomorrow, such as some big swing in one of the markets. So just stay tuned for that, and I'll keep you posted on what's been going on in our markets and economic situation today.